Welcome and thank you for joining me for Java. It's October 20th, 2024. It is Sunday. I've got a lot I would like to go over with you today. There's quite a bit happening in the macro market as well as the geopolitical issues that are going on right now. So let's get started with the things that could affect your market week and then also on a larger scale. There is quite a bit going on right now. So I hope you've got some fresh coffee and let's get started. So, with this, I would like to start with speaking about the markets and the risk, what happened the end of last week on Friday in particular. So, looking at our favored risk indicator, the MMRI, is relatively stable right now. It's 262.5. Now, the problem we're looking at is we are in extreme greed territory. It's at 75 again, it's jumped again, and that is showing the pouring in of retailers basically for another fleecing. Now, I'd like to take a look at what is going on behind these is the 10-year yield and relative strength of the dollar. Now, very important to watch this week forward, and I'll be with you every morning prior to the market open. But the 10-year yield back up 4.082, and the relative strength of the dollar is looking as if it's ready to rise as well. Why are these so important? The 10-year yield is the main indicator that most people in the market watch as an indicator of the debt market. And I'm going to be speaking about this quite a bit this morning because it has a major effect. The debt market eclipses the stock market by multiples much larger, much larger than the stock market, and it affects it. So, what happened Friday? Both of these basically pulled back and dropped down. This gave room for the stock market to kind of take a bit of a run, if you will. There were also some other factors, but looking at the stock market, hit record highs again. Should be no surprise, been speaking about this, as well as the inflationary forces behind it. So we've got some currency wars happening in the background of this. And what's going on is we've got basically countries scrambling between what is going on for the strength of their currencies because it affects their trade and their dollars, therefore their economies. And we've got basically what's going on is what we call a race to the bottom. And this is the currencies trying to devalue at a faster rate than the others. So within the reason. So we've got cryptocurrencies with this are now back above 68,000 for Bitcoin and looking very stable there. So we've also got with that, they have approved Bitcoin ETF. So more money about to pour into Bitcoin now that people can trade options and more derivatives. This is approved by the SEC. Now, this tells the larger story basically that they are approving this as an actual asset. My take on this is rather than it's fine to trade on your ETFs, but hold the real asset, hold them on your own, meaning your own keys, not an exchange if you aren't trading it. Same thing, gold and silver hitting all-time highs along with the market. So this is showing a major distortion here. We've got gold, $2,736.60 an ounce. Silver, $33.92 and 90, almost 93 cents an ounce. Now, what is this showing? This is showing a shift in the markets, first off. Second, silver is showing an issue with the supply versus the demand for the physical, and that is going to come a little bit more apparent here quickly. The derivatives on the market have been suppressing the price for some time. So now, as we're watching this shift into real assets, that will become more significant. Now, we've got Business Insider saying America is entering a new economic super cycle. Now, this couldn't be more true, but the problem is, which direction is it going to head? So it's completely shifting off of being the US dollar being the reserve currency is probably the largest threat globally to the Western world for certain. in quite some time. I'll go into that a little bit more. So the sentiment right now, investors looking at whether the top is in on that Friday rally. Now, the volatility index is down a good amount, but we're looking for possibly a reversal this week. We've got the 10-year yield we want to watch. I'm going to go a little bit more into treasuries versus banks, Bank of America in particular, and energy, as I said prior, is going nuclear. So we've got Wall Street's focus. We'll go into the calendar. This is their earnings. We've got some major companies coming out. So the largest companies in the world announcing their results. This includes Tesla. We've also got Boeing coming out along with a couple of announcements. They've made a tentative deal on the strike, as well as a couple of other things they've got rolling out that could be positive for the stock. So we're hearing from Verizon and quite a few others. Now, aside from earnings season, we've also got the economic calendar quite busy this week. So we're going to be getting basically flash PMI readings on manufacturing and services, goods orders, and some housing market data. Then we're also going to hear about the Fed's beige book on economic activity. Now, with this, I'd like to go into a few other things. First off, I want to bring up what I've been speaking about. This is energy in particular. Now, the grid is beginning to show some major stresses in particular areas. This quote right here basically sums it up. We have companies that didn't exist 24 months ago now asking for 100 megawatts of power. This is largely on the artificial intelligence push, also with cryptocurrencies, as well as the running of these data centers that are basically running the backbone of all of this. The moving banking over to this sector, moving all of the trading is on this sector, and as they tokenize everything, it is only going to advance from here. So now I would like to take a little bit of time to speak about what's going on with the banks and behind some of this that they're not telling you about. Now, first off, we've got this is source from Bloomberg showing foreign deposits, including US domestic bank deposit outflows. Now, this is the worst it's been in years. I believe since 2008 is when prior to this. So bank outflows, no deposits. We've got US banks' unrealized losses soaring to 7 times 2008 crisis levels. Nothing to sneeze about. We've got rising levels across securities. So this is what the mainstream media is going to tell you. Or basically, this is someone who writes articles and really doesn't have a grasp on what is actually going on in the banking industries, because what they're saying right here, what's truly driving these losses, a big chunk comes from residential mortgage-backed securities. Higher mortgage rates sent the prices of them plummeting, throwing banks deeper into the red. Now, while this is true, that there is quite a few residential mortgage-backed securities, it goes much deeper than that. The situation, as this says, isn't much better for corporate bonds and treasuries. Rising interest rates have hammered the valuations, pushing unrealized losses even further. Now, in reality, this is actually a bit reversed. So treasuries is the largest issue right now, with corporate bonds second, and mortgage-backed securities now are at the lowest of these that are having an effect. Now combined, massive. So still an issue. However, I'm going to go into this a bit further. Now with this, we've got the question, is gold safer than US Treasury bonds as federal debt keeps soaring? This question is posed because US Treasury bonds have typically been considered safe as the sovereign behind it, or United States government, has been known not to default. Now, a couple of things on this. First off, Treasury bonds, the prices, as everyone starts selling them, meaning global banks, not just smaller retailers, large scale selling of Treasury bonds will basically drop the price. So as it come really low in price, they need to entice people to invest in that debt. So they raise the yield in order to get people to purchase it. So this right here will cause a spike in the 10-year yield in the treasury bonds that they will be looking at. So the reason we say watch that 10-year yield, when you see that spike, basically indicates the world is dumping the treasury bonds, therefore dropping the price, spiking the yield. Yes, gold is safer in a couple of ways. So watch for this. That is when things basically begin to implode. So, quick note here. We've got this. I brought this up before, saying the math says it's getting harder to break into the middle class. Story isn't about breaking into the middle class. It's that we have middle class and it's rapidly dwindling. So we've got America's best retirement towns for the middle class. It's getting wiped out. Did you realize it should replace that class with caste? Because we are now in America in a caste system and it's going to a 2-tier. So you can be upper caste or lower caste and you will not be able to, as this says, break once you're in that caste. This means your family, your downline, your children will be born into the same caste you are, as similar third country worlds or other countries around the world. I'd like to go a little bit more about banking. So speaking about these unrealized gains and losses in the investment securities. So this is in treasury bonds. And we've got basically what is going on here. The unrealized losses are massive in these investment securities. So a couple of questions we're going to address here, but what's going on is during the COVID crisis of 2020, banks purchased $2 trillion of treasury bonds and agency mortgage bonds. Now, they did this because, first off, they're quote unquote risk free in the sense that the United States Treasury will always buy them back. The problem is these bonds were extremely expensive at the time, highest prices in capital markets. Now, part of this is from Stansberry research. So, why buy the assets when they're so expensive? The banks at the time didn't have much of a choice. Now, here's how it works. The government prints trillions of new dollars. So these trillions of dollars find their way out. They give them to the banks. Basically, that's how they filter them out. In the meantime, lending came to a halt basically because the economy was shut down. No one was borrowing. So the banks had to do something with all of this excess money. And since they can't loan it out, what they have to do is they have to purchase bonds. Now, these treasuries that they had to purchase basically now are at a major loss with the rates changing. Now, with all of this, we've got Bank of America as the largest holder of these bonds. Now, we know the size of the bank's losses because the value of those bonds are very closely related to this 10-year yield on the Treasury bond we speak about. So even the Federal Reserve reports about this, the correlation between the 10-year yield and the weekly series of unrealized losses. Now, when they came out with this report, the data was so terrible that the Fed actually stopped reporting this. So this is how much of a difficult trouble that this is. It's massive. And basically, the global markets are beginning to sell bonds because they see all of this going on. And this is causing interest rates to move higher. Now, when we watch this spike that is going to happen, it will threaten the banking system because it will increase all of these realized losses much larger than what they can basically purchase back. So Bank of America is at the forefront of this. The only thing that would save them from going under, in my opinion, is not financial advice, but basically they are lined up for a bailout. So in reality, the market for these bonds is the most liquid in the world. They are the ones that Everyone is willing to purchase. The banks know exactly what they're worth and how much they've lost. But not only that, they are the world reserve currency, which means the Treasury can print their own money and buy back their own debt. So with this is basically the opposing argument to this is that the Treasury could, at this time, when everyone else is dumping the bonds because they must sell at a loss, they will basically purchase back their own debt. And this is how they would get out of the massive amounts of government debt that they've got right now. So, this is the two sides of this argument. But in either event, as this comes out, what we can expect gold, silver, commodities will increase in price. They're going to skyrocket also. And then also we can expect the government to continue coming out with schemes and lying about how the money is safe. The money has already been spent forward, and they don't want to tell you because this is their end game to force into a revaluation on the lower levels because they don't deal in currency, only middle and lower class do. So they will, at this time, come out with their new solution to this. So now for the questions. Is your money really safe in an FDIC insured fintech account? Well, no. Second question, mortgage rate dip sparking housing market revival. What buyers and sellers need to know. Second one, no. This will not increase housing demand. Third, this is about the whole thing with the FDIC. We've got a new failure. Oklahoma Bank fails amid claims of false and deceptive bank records. Now, failure, $107.8 million bank, will also cost the Deposit Insurance Fund, the FDIC, an estimated $43 million. Now, this is just one bank of multiples that are set to fail. How long do you think the FDIC can stay in with this? Well, as long as they can print. And I would just like to make one last note on this. If you think you're not involved with this because you're not in America, we just had TD Bank, which is Canadian. And we've also got this note on European bank mergers. So this is a global issue, I'm sorry to say, my friends over in Europe. So a couple of last things that they could possibly use as cover, so they're going to shoot this off. Literally, US Congress saying Putin's use of North Korean troops must be the red line. We know they're there. We know they're being used for sure. We had leaked US intel files showing the Israeli military plans basically to strike back at the IDF. Now, Iran is saying that if the United States knows these plans, understands what they plan on doing for retaliation, that they will hold them accountable for a potential attack. Now, not too worried about Iran. They still don't have a lot of clout or ability in response to the United States, but they are building alliance. Now we've also got Switzerland abandoning their neutrality, getting in on this whole thing. And we've also got China basically calling on the military there to strengthen preparations for war. Now, this is not necessarily Taiwan. It's on a broader scale, things ramping up. Basically, we've got a hot couple of weeks here until the elections, and that's really when we're going to see some more things. So, with all of this craziness going on, I wish you all a wonderful rest of your weekend, and I'll be back in the morning. So, until I see you again, my friends, stay free.